All right. If you've been following the stock market in 2023 and 2024, you probably know that AI stocks have been on a tear. And so investors are trying to get in on the next hottest AI stock because Nvidia has already exploded. They're looking for that other AI stock. Well, ARM Holdings and Palantir Technologies are two excellent AI stocks that are benefiting from the increasing effectiveness of AI. But which one of these two is the better AI stock to buy? That's what I'll answer in this video here. I'll compare Palantir Technologies and ARM Holdings stocks on revenue, on operating profit margin, on cash flow from operations. And finally, I'll look at the valuation and look at how expensive they are on a forward price to earnings basis to determine which one is the better AI stock to buy today. So let's start with revenue. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so we have a longer history of revenue for Palantir Technologies than we do for ARM Holdings, given that ARM Holdings has been a more recent IPO compared to Palantir. What we do notice with both of them is solid revenue growth. ARM Holdings has increased its trailing 12-month revenue to $3.233 billion, and it's growing faster than Palantir, which has grown its revenue to $2.33 billion, up from around $800 million in 2020. Palantir Technologies' recent strategy of going in and having boot camps for the enterprise segment, demonstrating its capability, has been working well to secure new deals with commercial enterprises. Of course, Palantir's history has been with strong traction with domestic North American U.S. government, primarily business. That part of its business has been doing really well. What Palantir needed for that next driver of growth was commercial business, enterprises. Given that Palantir arguably, well, not even arguably, it's the best in class in the AI software space. And so, of course, every business would love to have Palantir's service. The question has been on price. Can they afford it? And when Palantir comes into your business and demonstrates how good they are, demonstrates their return on investment, it convinces businesses that they can afford Palantir because of what they're going to get in return. So that's working really well. That could drive growth for Palantir. ARM Holdings, meanwhile, has been growing its revenue nicely, somewhere around the 20% range, depending on the quarter. Next year, it's forecasting roughly 20%. And then for several years ahead, it's forecasting that it can grow revenue at roughly 20% per year as more and more businesses are utilizing ARM Holdings' patented technology to create the products in their tech category. ARM Holdings, holding these patents, can generate licensing and royalty revenue that comes with lucrative profitability longer term. So they both have excellent prospects in terms of revenue growth going forward. I would say very, very similar. It would be hard to pick a winner between these two on revenue growth over the next 5 years. I would say they're going to be neck and neck on revenue growth over the next 5 years. The next metric I wanted to compare is on operating profit margin, and Palantir holds the lead here and has the better trend. You'll notice here Palantir's operating profit margin at 8.43% is better than ARM Holdings at 3.62%. But also Palantir has been improving its operating profit margin rapidly over the last several years. The company undertook a solid cost control measure that has kept its cost under control while revenue has grown. Although in the near term, I'm watching closely because Palantir said they're going to hire more folks in order to fulfill this strategy with going into businesses and operating the boot camps. It's gaining traction, and Palantir feels it needs more people to fulfill on this opportunity. So I'm watching to make sure they continue this trend of higher operating profit margin as revenue grows. I'm relatively confident that they will be able to achieve this because they've demonstrated skill in this regard over the last several years. So I'm relatively confident that they can achieve this metric. ARM Holdings, meanwhile, will also likely improve its operating profit margin over the next several years as its investments in research and development offer economies of scale, revenue grows, its costs stay relatively flat, and that will expand its profit margin longer term, although in the near term, they may remain relatively low in their operating profitability. Now, cash flow from operations to sales is much higher for both of these companies because they use significant sums of stock-based compensation, which is a non-cash expense. This goes in your cash flow statement as a non-cash expense because you have to account for stock options and stock grants, etc., on your income statement as an expense. You have to account for the value, the fair value of that option that you're granting your employee. But since it's an option and since it's in the form of stocks or equity ownership in the business, it's not actual cash going out from your company. So it doesn't show up in your cash flow statement. And so that makes cash flow from operations for Palantir and ARM much higher than profitability. Look at the numbers here. 33% for ARM, 28% for Palantir, much higher than their operating profit margins, which are still in the single digits and relatively low. You could see that much higher. But also, they're both demonstrating solid upward trends here in this metric. Palantir has moved up to 28%, up from negative 25%. ARM has moved up to 34%, up from around 28%. So they're both moving up and to the right, which is the direction you want to see when you're considering an investment in a business, especially a growth business. Finally, I wanted to compare these two on valuation, and these are not cheap stocks. They are on the expensive side of stocks in the market today, but they are also growth stocks. And when you're investing in growth stocks, they, for the most part, will trade more expensively than non-growth businesses. Palantir trading at a forward price to earnings of 63, cheaper than the forward price to earnings of 79 for ARM Holdings. So given the metrics we looked at, they were similar in revenue. Remember, we highlighted revenue growth is likely to be similar over the next 5 years. Palantir had the better operating profit margin and the better trend in the metric. Palantir was close in the cash flow from operations and had the better trend in the metric, while ARM Holdings was better in terms of cash flow from operations, but the trend was not that distinguishable from Palantir. So given those primary metrics we considered, and given the competitive advantages and the industries that they operate in respectively, I don't feel ARM Holdings has earned a premium valuation over Palantir. I don't feel it should be a more expensive stock. And so in this comparison, Palantir being the cheaper one, if I was to pick between these two AI businesses today, I would say Palantir is the better AI stock to buy for long-term investors. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.